Hi friends, today we are going to discuss about mutual funds and how to invest in mutual funds. A mutual fund collects money from investors and invests the money on their behalf. It charges a small fee for managing the money. Mutual funds are an ideal investment vehicle for regular investors who don't know much about investing. Investors can choose a mutual fund scheme based on their financial goal and start investing to achieve the goal. How to invest in mutual funds? You can either invest directly with mutual fund or hire the services of a mutual fund advisor. If you are investing directly, you will invest in a direct plan of mutual fund scheme. If you are investing through an advisor or an intermediary, you will invest in the regular plan of the scheme. If you want to invest directly, you will have to visit the website of the mutual fund or its authorized branches with relevant documents. The advantage of investing in a direct plan is that you save on the commission and the money invested would be sizable returns over a long period of time. The biggest drawback of this method is that you will have to complete the formalities, do the research, monitor your investment all by yourself. Mutual funds can be categorized based on asset classes, structure, or investment objective. Now we will try to categorize mutual funds based on asset class. This Sebi has categorized mutual funds in India under 5 different broad categories: equity mutual funds, debt mutual funds, hybrid mutual funds, commodity based mutual funds, and 5th one is solution based mutual funds. Equity mutual fund scheme. These schemes invest directly in stocks. These schemes can give superior returns but can be risky in the short term as their fortunes depend on how the stock market performs. Investors should look for a long investment horizon of at least 5 to 10 years to invest in these schemes. And the second mutual funds category is debt mutual funds. These schemes invest in debt securities. Investors should opt for debt schemes to achieve their short-term goals that are below 5 years. These schemes are safer than equity schemes and provide modest returns. And the third category is hybrid mutual funds. These schemes invest in a mix of equity and debt, and an investor must pick a scheme based on his risk appetite. And the fourth category is commodities based mutual funds. Investing in gold or gold related mutual funds comes into this category. Fifth category is solution oriented schemes. These schemes are devised for particular solutions. Fifth mutual fund category is solution oriented schemes. These schemes are devised for particular solutions or goals like retirement and children's education. These schemes have a mandatory lock-in period of 5 years. Mutual fund charges. The total expenses incurred by a mutual fund scheme are collectively called as expense ratio. The expense ratio measures the per unit cost of managing a mutual fund. The expense ratio is generally in between 1.5 to 2.5% of the average weekly net assets of the schemes. Thank you.